Thank you very much, and thank you, Vice Chancellor, for the invitation to be here today. The subject I've chosen for the address today is Indian economy in India in the global economy, the next decade. It is timely subject for us to think about since Prime Minister recently has announced his ambition to bring India into the Viksit Bharat status by the 100th birthday of India, which is, or really, the 100th anniversary of independence in 2047. What I will do towards that goal is to talk a little bit about, how India has evolved in the last 20 years or so, and then try to draw out some implications from their experience with respect to where we can head in the next 10 years or even longer if we want to draw it out into 2047. Now, India initially, of course, started, had a slow start. The first Prime Minister, Pandit Jawaharlal Nehru, had a clear recognition that at the time the country was too poor to solve the problem of poverty purely through redistribution. And in the discovery of India, he wrote that there was only poverty to redistribute. There was hardly any wealth to redistribute. Therefore, he argued that in order to really in order to really rid India of its appalling poverty, the country needed to grow about sixfold in 10 years, but that seemed too ambitious. So he wrote that we set a target of 300% growth or threefold, that the economy should grow into about 300% of what it was at the time in 10 years' time. So in this sense, the objective that the Prime Minister had set was quite the right one, which is to get rid of poverty. Instrument that he thought was for it, namely growth, was also the right one. But as it turned out, the model that ultimately Prime Minister Nehru chose was not the right one. It simply failed to deliver growth. He, having come out of this area, this era during which much of Africa and much of Asia had been colonized, he felt that it was essential for India to become self-sufficient, and so he took a very strong stance against participating in international trade. So that was one feature of that model, that he did not want to depend on international trade. And if we were not going to depend on international trade, and the principal way to achieve higher growth was to increase investment as rapidly as possible, then he also argued that we needed to develop our own heavy industry. In the end, you need machines to invest, and that, of course, means heavy industry. So the model he chose really was very heavy industry dependent and a closed economy model, autarkic model. And that, in the end, given the fact that India was a highly labor-abundant economy and highly capital-scarce economy, that failed to use the abundant factor, namely labor, effectively, and at the same time, very scarce capital got employed in industries that employed very little labor. So in effect, we ended up, at one extreme, capital sitting in sectors such as steel, machinery, fertilizer, chemicals, etc., with very little labor, and at the other extreme, labor sitting in the cottage industry, village industry, household industry, with almost no capital. And that really, in a way, at least in hindsight, was the worst possible allocation of resources. What we needed at the time was to spread the scarce capital over a larger volume of labor, so that labor could be used effectively to produce higher productivity, and also over time give the labor to the opportunity to develop skills. When the bulk of labor sitting in these very tiny cottage and village and home industries had no capital to work with, the skill development obviously couldn't have happened. So in any case, as it turned out, and that sort of model then continued. The third characteristic of this model was reliance on a very large public sector. Once again, Nehru did not expand the public sector by buying off the private sector industry. Instead, his vision was to really increase the role of the public sector through progressively larger and larger share in the investment each year of the public sector, and that's how he built up. But even that process, by 1980 had resulted in about 3/4 to 80% of the paid up capital ending up in the public sector. And 7 out of the 10 largest enterprises were in the public sector by that time. So in effect, the reliance on the public sector, very heavy industry, and no competition through international trade, all of that added up to rather small or rather slow growth rate. But that, eventually we all know that history, that finally a series of developments and factors led to the 1991 liberalization, which really was a turning point, bringing economy back to the private sector, to the market-driven forces, and reduced role of planning. And that process, although started in 91, continued and still continues within the Indian democratic setup. The process of change is slow, and whereas in the authoritarian China, Deng Xiaoping could bring about the change rather quickly. He too faced some internal opposition, but largely he was able to to change the course of the Chinese economy a lot faster than we were able to do within our democratic structure. And that, of course, also means that we still are struggling with certain policies which require changing. That also meant that the growth in the economy was not as fast as in some of the, China on the one hand, but also in the earlier years, 60s, 70s, and 80s, South Korea, Taiwan, Singapore, etc., which had all been able to grow, 9 to 10% per year. And within 3 decades, they had more or less transformed themselves into upper middle income countries. So our struggle here is still on. Now, how did we do after liberalization began? And I want to take the last 20 years. We do not recognize or realize the fact that India's growth, though in real rupees, has been maybe below 7% or so in the last 20 years. I'm taking the years 2003-4 to 2023-24, if you will, or 2022-23. During this period, in real rupees, our growth has been over the 20-year period about a little below 7%. But if you look at the growth rate in real dollars, that has been significantly higher, about 7.9%. How does that work? That works because rupee itself in real terms appreciates as per capita incomes rise. And this has to do with the fact that as per capita incomes converge across countries, the price levels converge also. And as a part of that convergence of the price levels, the currency of the country, which is coming from lower per capita income to higher per capita income, generally appreciates. So there is, a literature there with Balassa Samuelson, PPP literature and all, which will tell you how exactly this process works. So during this period, the 20 years when India has grown, given that it starts from low per capita income and moving towards higher per capita income countries, the currency of India has also been in real terms appreciating. The net effect of all that is that in real dollars, the economic growth in India during these 20 years has been about 7.9%. In current dollars, which is something you can easily download the data from WDI, the World Development Indicators, the growth rate during these years has been a little about 10%. And then if you apply basically the US GDP deflator, now we're talking about dollars, and therefore the relevant GDP deflator becomes the US GDP deflator. That's about maybe 2%, 2.1, 2.2%, somewhere there. But so in net, it turns out in real dollars, you have grown 7.9%. Now, from this, we come to asking the question, what kind of growth, if we were to be able to maintain that kind of growth over the next several years, where we could actually be heading. And I want to really, rather than take 10, I'll take the full 2047 year as the terminal year. And first one can ask the question, well, what kind of growth do we need in per capita income to actually reach the Viksit Bharat status? Now, obviously, you need a benchmark for that. What does it mean to be Viksit Bharat? And the general kind of benchmark that is taken as the definition of the high income country, which is what we may call the Viksit Bharat, that is provided by the World Bank. That's the only really generally widely accepted definition. And the World Bank definition of a high income country is a per capita income of about 14,005 in 2023 dollars. Okay, that's 14,005. So we will just say around figure $14,000 per capita income in 2023 dollars. Okay. Now come back a little bit. India's per capita income in 2023 is about $2,580. And what we are asking is whether, so this is 2023 per capita income, and what we are asking is whether India can reach the per capita income of about $14,000 by 2047-48. This is about a 24-year period. To get there from $2,580, what you need is a growth rate in per capita income of 7.6% in constant dollars. Okay, because remember that my threshold of $14,000 per capita income is defined in terms of the 2023 dollars. Therefore, I have to compute the growth at constant in constant dollars and see whether by 2047 I can get to that level. It turns out it's a fairly straightforward calculation to do, that if your per capita income is 2,580 at about 7.6% growth rate, you will cross that threshold of 14,000. You'll get to something like 14,000 plus maybe 14,800 or something of that sort, That's a straightforward calculation you do. So if India really needs to grow at 7.6% in per capita terms, remember. What is the corresponding GDP growth rate? That's a question we ask now. Now, all estimates, you can take the United Nations population division, population growth figures, that places India's population growth rate during this period at somewhere from 0.5 to 0.6 percentage points. So what that means is that 7.6% plus the population growth, let's say we will take the 0.6% population growth rate, that gets you to about 8.2% GDP growth rate. So the GDP, what you need is for the GDP to grow in constant dollars between 2023 to 2047 at 8.2%. In the last 20 years, we have grown 7.9% is the case I have made to you. So it's not very far. Okay, so that's not very far. What you need is an acceleration by another 0.3 percentage points. Most likely population growth is going to be a lot slower than that because India has been already at the total fertility rate of in 2019 and 2021, if you go by the National Family Health Survey. So very likely the growth rate in population is going to end up being less than 0.6, which is the underlying assumption of the United Nations population division. So either way, even if you take the 0.6, which is what they are assuming, it still requires 8.2%. And going from 7.9 to 8.2% is a perfectly feasible proposition. That, I think, needs to be argued, of course. I'm just telling you right now that it's a perfectly feasible proposition, but one needs to come back and explain why is that feasible. So there are 2 or 3 factors, I think, that are very important working for India for that kind of growth to happen in the next 23, 24 years. First of all, of course, very important, India is a politically very stable country. Political stability, general law and order is a prerequisite. If you don't have political stability, you don't have law and order, there is no game. So, you can see in different states, first thing that when you get a good chief minister coming in, the first thing they try to do is bring in law and order. And really growth resumes only after credibly law and order has been established. So, but for India, that is a given. I think, barring some outside factors or what have you, it's a reasonable assumption that India will remain a stable, politically stable, democratic country. Then we come to the fact that India's per capita income today is still only $2,580. Now, this is a relatively low level of per capita income. Today, you got countries like China, South Korea, Taiwan, which have significantly, many multiple of that kind of per capita income. What that tells you is that if one has the right amount of capital, right amount of skills, and right amount of and the right technology, you can per capita incomes which are a large multiple of 2,580 are possible. We see China doing that. We see South Korea doing, China is already about 4 times of India's per capita income. South Korea is about 3 times of China's per capita income. Singapore is yet another factor of 2 or 3 over South Korea. If all these countries can produce that kind of per capita income, we know that with the available technology today, use of capital and skills, India can do it also. So it will be a slower process. Of course, you can't overnight acquire skills, and you cannot overnight get that kind of capital stock that on a per capita basis China or South Korea or Singapore have today. But over time, that can be accumulated. And so certainly we also know the past experiences of South Korea, Taiwan, China, etc., that they have grown at that kind of a rate. So it is certainly in this sense feasible purely through catch-up. You don't even need new innovation. Even the existing technologies that are available will allow you to get there. So that is a feasible proposition in this sense. So that's my second point. The third point, which is working for India, is its demography. While growth is slowing down, has slowed down, India's population, at least in the coming decade or two, is going to remain relatively younger. And the young population, so there are two characteristics of India's population. One, it's a large population, and the second is that it's a relatively young population. Both factors actually place India more favorably. Size helps you because that gives you the economies of scale in the provision of many public goods. When you build roads, when you build airports, you build develop ports, means of transportation, railways, etc. For the same population can use that on a per capita basis. Your cost of provision of of each of these public goods actually is lower than what it would be if the population base was smaller. So, and that in particular actually becomes even more relevant for the digital public infrastructure, because with the larger population gives the economies of scale, both in terms of the provision of the public good as well as the use or consumption of the public good. The former, meaning in the provision, what it means is that once you have built up your digital public infrastructure, your cost per unit for that provision actually is practically nil. Once you have provided once the infrastructure is there, adding a few more individuals to use that public infrastructure, the extra marginal cost is very tiny. But also, as more people use the digital public infrastructure, the utility to the existing users of using it increases because you are interacting with a larger population. So both in the provision of the public good, as well as in the use of that public good, your costs decline. Excuse me. So that is the advantage of the size. But in addition, there is the young population, and that factor helps you as well. A young population means that the workforce for the given population is larger. So if you're thinking in terms of young versus old population, the larger the proportion of young population, larger the proportion of workforce in the population, and that of course on a per capita income basis purely in arithmetic terms means a higher per capita income that they can generate. But also the young population is in its working phase, and therefore it's a saver, whereas the older population dissaves, it lives on the past savings. So there again, the savings rate, it leads to a higher savings rate, which is also essential to accumulate capital faster. So that also is a feature that's going well for India. And the last one, I would say that a lot of the economic reforms that have been done in recent years, the return to those economic reforms is still to be realized. In particular, I would say, GST and the bankruptcy code, but also now, in particular, in the last 4 or 5 years, the build-up of infrastructure has been impressive. Any of you who have been traveling in India, which certainly I've been doing on behalf of the Finance Commission, we are required to visit every single state, and I have now visited 18 states, including Odisha. as a part of this exercise, and it's very impressive, the infrastructure that currently exists. So the return to that is still to be fully reaped. And moreover, finally, our reform process itself is not yet complete. And as we complete that reform process over the next decade or longer, there is return to be reaped on those as well. So I come back finally to the point that, what we are talking about is is to accelerate GDP growth rate from 7.9%, which is what we have achieved in the last 20 years, to 8.2%. That's a doable. That's very much a doable feat. So this is where I think, and in this process, of course, as we get to 2047, we will, in not more than another maybe 4 years or so, we should become the third largest economy, and by the time of 2047, we'll be at a point where the fourth largest economy will be a very small fraction of India's economy. So the global economy by that time is very much going to look like, I suspect United States will still, in 2047, will still be the largest, followed by China. Maybe China will overtake, we'll see, but those will be the largest. India will be certainly behind those two. But then after India, the next one, which under the current circumstances looks like Germany, is going to be quite far behind. And just as we saw geopolitically, once China became a 10 trillion or 11 trillion dollar economy, the geopolitics saw a transformation. And very similarly, as India gets to even, 2047 will be much larger, but even within the decade, as we get to something close to 10 trillion, $9-10 trillion, Germany would look significantly smaller than India already, and that's going to mean geopolitically a vast change in the governance of the global economy, as well as global polity, global politics. So I think future looks very good, very bright. That's how I see it. As skeptics, we can think of many different things that might go wrong and all. But as far as I sort of see it, my general nature is one of optimism. I really think that the future actually looks incredibly good, and most of you are way younger than I am, so you will see India very different from the one in which I grew up, and even the one that I would eventually leave. So look forward to that, and let me once again thank the Vice Chancellor and the other organizers of the conference for inviting me. Thank you all, and all the best.
Thank you, sir.